Hello, everybody, and welcome to today's presentation on advanced 1031 strategies. My name is Jeff Stechmann, and I'm actually the Business Development Director for Asset Exchange Company. Before we kind of dive into the presentation, I just want to give everybody information on how we're going to handle today's presentation as far as questions go. I'll open the floor up to questions at the very end. Because I find in a lot of cases, if you do have a question, most often we're probably going to be covering that subject in an upcoming slide. But if we don't, again, at the end, we'll open the floor up to questions. There's a little box on the right-hand side that says questions. Right there is where you want to type it in. And then also, don't feel like you have to write every single thing down today, because you will receive a recording or a link to a recording of today's presentation if you want to listen to it again. And then also, one other thing, a lot of what I'm going to talk about today I have in PDF form. So if you'd like to have those PDFs, please let me know, and I can email them over to you. My contact information is on the screen, and it'll be up on the screen again at the end. Notice my email address isn't up there, but I can add that, and I'll give that to you guys at the end anyway. So let's go ahead and dive in. Looks like we had a few more people join in. So again, my name is Jeff Stechmann, and I'm the Business Development Director for Asset Exchange Company. To kind of give y'all some, background about myself, I've actually been in the business for 25 years. I did a lot on the title side of the business to kind of get my start. For those of y'all that have been in the business as long as I have, I used to work for a company by the name of Lawyers Title. I'm originally from New Orleans. I now live in the Tampa, Florida area. So if y'all hear the accent come through, please forgive me. Every now and then it rears its ugly head. But as long as I've been doing this, I unfortunately have seen the really bad times in the real estate industry, and I've seen the really good times as well. And hopefully we never have to see those bad times again for those of y'all that have been doing it as long as I have. So let's just kind of dive right in, kind of give y'all some information about the company. Again, we're Asset Exchange Company, and we've actually been in business since 2006. Excuse me. And over the course of our existence, we've done about 30,000 1031 exchanges. It's all that we do. We don't provide any type of closing services. We don't provide any type of financial services. In the industry, we're known as a qualified intermediary, QI for short. Now, some of the terms you may hear people refer to is an accommodator, or another term is a facilitator, or just simply an intermediary. But most often people just call it QIs for qualified intermediary. Now, a word of caution about QIs, at least on a federal level, there actually is no federal agency that oversees what we do. So, what exactly does that mean, right? Well, what that means is anybody out there can be a QI. There's no type of requirements that you have to have any type of E&O insurance. There's no type of requirements you have to be bonded. There's no guidelines on where you hold the proceeds from the sale. That's our main job in a 1031 is we hold the proceeds from what we refer to as the relinquished property, the property being sold in a 1031 exchange. Well, on a federal level, there's no guidelines on where you have to hold those proceeds, what type of funds you have to hold those proceeds in. It's a really scary thought. So I always like to, mention that to people that there is no oversight on a federal level. So, if any of you guys on the line are currently involved with a 1031 exchange, just make sure you do your due diligence and you're dealing with a reputable company. The great news when you deal with us is we're actually California-based. Our home office is in San Francisco. And because we are California-based, the state of California actually has what they refer to as the California Franchise Tax Board. Now, that state agency, that Franchise Tax Board, actually oversees qualified intermediaries in the state of California. We're subject to audit by that Franchise Tax Board. They do require us to carry minimums for the E&O insurance we have, the bond that we carry. There's guidelines in the financial institutions where we hold the proceeds, the type of funds we hold those proceeds in, which is great for anybody that deals with us in California, right? But anything that we do nationwide, because we do exchanges all over the country. Well, that Franchise Tax Board has oversight in anything that we do, not just California property, but any properties that we work on, any files that we work on. Because as I mentioned, they can come into our office at a moment's notice and audit any of the files that we work on. So great news when you deal with us. As far as our ownership goes, we're actually owned by two gentlemen, and they've been in the 1031 exchange business, specifically the 1031 exchange business, for like 20 plus years, one of which is actually a tax attorney. Now, his name is Adam Skarsgård, and Adam is actually considered like a 1031 exchange expert. He's been called upon to testify in tax court as an expert witness on 1031 exchange. He even occasionally teaches at UC Berkeley on real estate and tax law, that type of thing. The reason I like to bring his name up is because one of the things that we offer that I don't know if any other QI in the business offers is any of the exchanges that we're involved with. If for some reason they were to get audited by the IRS, well, we would actually provide free audit support. We would work hand in hand with the client's CPA, helping to defend the audit. And it primarily would be done by our tax attorney, Adam Skarsgård. All right. So let's talk a little bit about why investors exchange. Well, the most obvious reason and the single most reason that we see people doing exchanges or investors doing exchanges is for tax deferment. So typically when you have real property and you sell the real property, if you have any gain in the property, on average, about a third of that gain goes towards paying taxes. So that's the single most reason we see people doing 1031 exchanges. But what are other things that we see? Well, with exchanging, the replacement property that you purchase in a 1031 exchange, well, that purchase price must be equal to or greater than whatever the sales price was on the property that was sold, the relinquished property. So I'll call this next point, I'll call it buy more property. So what someone will do is they use the savings of not having to pay the taxes when they do a 1031 exchange. They use that savings and they leverage that into buying a better property. Hopefully it's going to be a better income producing property. All right. What else do we see? Well, diversification and management relief. With exchanging, you're not limited to just selling one property and buying one property. You can do that, or you could sell one property. You could buy multiple properties. You could even sell multiple properties in one 1031 exchange and buy a single property or buy multiple properties. All right. It doesn't matter. As long as what you're selling, you're using in your trade or business, or you're holding it for investment. And as long as what you're replacing it with, you're using that real property in your trade or business, or that you're holding for investment. All right. So back to diversification and management relief. All right. Geographic diversification. I'll give you guys an example. Let's say you sell a property. Let's say that property is located in California. Now, California has some of the highest property values in the entire country, right? So you sell that property, that investment property, in a 1031 exchange, that California property, and instead of replacing that property with another property located in California, you say, well, hey, I want to buy one property in Florida. Maybe I'll buy another property in Texas, and then I don't know, maybe I'll buy a third property in Ohio, right? Because why? Because you don't want to be so geographically tied in to one particular real estate market, all right? Because, hey, maybe the real estate market in Florida starts to go down again. Well, at least you have that other property in Texas and that other property in Ohio. Hopefully those markets wouldn't be seeing the same downturn as the real estate market in Florida. All right, so geographic diversification. Now, management relief, that's another thing that we see. Well, I'll give you guys another example. I got a guy who lives in New York, all right? He owns 4 rental properties. Now, what he would like to do is he'd like to sell all 4 of those rental properties, and he wants to retire and he wants to move to Florida. But you know what? He doesn't want to manage property anymore. So what he wants to do is he wants to sell all 4 of those rental properties in one 1031 exchange, and then he wants to buy maybe like a small apartment complex, maybe with some on-site management somewhere in Florida where he wants to retire. Because why? Because he doesn't want to manage property anymore. Basically, he wants to retire and he just wants to collect a check every month. So 1031 exchange is perfect for him. Now, another aspect with exchanging is you're not even limited to how many times you can do a 1031 exchange, okay? I can sell property today. I can buy property today, investment property, hold on to it for a period of time, later sell it, do a 1031 exchange, defer my taxes, buy another replacement property, another investment property, hold on to that property for a period of time, later somewhere down the road, sell that property, do another 1031 exchange, and I can keep deferring and deferring and deferring over the course of my lifetime. All right. Now, what people will do is they'll actually use 1031 exchange as an estate planning tool. All right, because you can keep deferring and deferring over the course of your lifetime and keep deferring your taxes. And when you pass on, if you have any heirs that inherit your property, they're going to get what's referred to as a step up in basis. All right. And basically what that means is whatever the value of the property is when they inherit it, that's their basis. All right. All of those deferrals that you would have done over the course of your lifetime, basically they go away and no one ever has to pay the taxes. Okay. Now, on the flip side of that, I just said, hey, you're not limited to how many times you can do an exchange, right? Well, let's just say you buy a property, an investment property, you hold on to it, you do a 1031 exchange when you sell it, you buy another investment property. When you sell that one, you do another 1031 exchange and defer your taxes again. Let's just say on the third property, when you go to sell that property, you say, you know what? I don't want to do another 1031 exchange. I'm okay with just cashing out and paying my taxes. Well, I'm going to be responsible for those taxes and all of those deferrals that I did up until that point. I'm also going to be subject to having to pay those taxes as well. All right, because with 1031 exchange, it's a tax deferral. It's not a tax avoidance. Okay. All right. Tax deferral meaning that you may have to pay it someday, right? But when you pass on, when you die, if you have heirs that inherit your property, well, they're going to get that step up in basis, and they're not going to be responsible. Nobody's going to be responsible for paying any of those taxes. I always make the joke, if you die correctly, you never have to pay it. All right, we call it the 3 Ds: defer, defer, and then die. All right, now, here's an example. What if I'm the heir, right, and I inherit the property, and I say, well, boy, this has some really nice cash flow. I'm going to hold on to it as an investment for my own personal use, my personal, income, to have the income coming every month, right? Now, if I hold on to it for a period of years, let's say, 3, 4, 5 years, whatever it may be, when I go to sell the property, if I have any gain from when I inherited the property to when I go to sell it, okay, I can do my own 1031 exchange and defer my taxes and basically start the whole thing over again. Okay, so again, an estate planning tool, another really, really good thing that you can use 1031 exchange for. All right, now let's talk a little bit about what are current tax rates. So when you sell real property, if you have any gain in the property, you're going to be subject to capital gains taxes. All right, and capital gains taxes right now are either 15% or 20%. Okay, the 15% historically was applied if you were single and you had income of less than $400,000 a year. All right, if you were married, you had income of less than $450,000 a year. That's where you were at the 15%. Now the 20% kicked in historically If you were married, if you were single, you had income of greater than $400,000 a year, or if you were married, you had income of greater than $450,000 a year. That's where you're at the 20%. I think the income levels have been adjusted. It might be a little bit higher now, but the point is, you're either going to have capital gains taxes of either 15% or 20%. All right. Now, on top of that, you may also be subject to, or you will be subject to, what they refer to as depreciation recapture tax. All right. That's an additional 25% tax. Now, what exactly does that mean, right? Well, the depreciation recapture tax is any depreciation that you've claimed for the entire time that you've owned the property. All right, when you go to sell that property, you're going to be hit with a 25% depreciation recapture tax just on the depreciation alone. All right, now, on top of that, you may also be subject to what they refer to as the Medicare tax, right? That's an additional 3.8% tax, right? What exactly is that? Well, the Medicare tax, that was passed back in 2010 with the Affordable Care Act, Obamacare, right? It went into effect in 2013. It was one of the things that they passed to try to offset some of the cost of the Affordable Care Act, all right? So when you do a 1031 exchange, you can defer having to pay any of these taxes, all right? Now, what am I not listing up there? Well, I'm not listing anything to do with state income taxes, right? Now, for those of y'all that are located in Florida, where I am, okay, well, we don't have state income tax, so we don't need to worry about that, right? But if we live in a state, or even if we're selling property in a state that has state income tax, you'd also be subject to state income taxes. Now, when you do a 1031 exchange, you can also get out of having to pay the state income taxes. All right. Now, every state kind of has their own way of you going about filling out some type of form or some type of process for you to get out of having to pay the state income taxes. All right. That's something where you'd want to get with your CPA and figure out exactly what that is. But the good news is it can be done. Okay. So how do you actually calculate what the taxes are? Well, I'm going to show you all a quick example. Now, this is typically done by a CPA, all right? But I'm going to give you all just a real basic example just to kind of give you an idea of what potential taxes could be, all right, when you sell real property. So in our example, all right, originally we purchased this property for $500,000. All right, now over the lifetime that we owned the property, we added in $25,000 worth of capital improvements. All right, now we took some depreciation for the lifetime that we've owned it. All right, we took $100,000 worth of depreciation. All right, and now we're gonna sell the property. We're gonna sell it for $1 million. All right, so in order to figure out what the taxes are, the first thing you need to do is be able to calculate what they refer to as adjusted basis. All right, and pretty simple. The way you do it is you take the original purchase price of $500,000. All right, you add back in the capital improvements of $25,000, and then you deduct out the depreciation of $100,000. All right, and that gives you an adjusted basis of $425,000. All right, now we're going to turn around. We're going to sell the property for $1 million. So we take that $1 million sales price, we deduct out the adjusted basis of $425,000. Right, and that actually gives us a gain of $575,000. All right, now, now how much of that number is depreciation? Well, $100,000 is, right. So we're going to take that depreciation out, all right, because that depreciation recapture tax, that 25% tax, is calculated as a separate line item. All right, so we'll take that $100,000, multiply it times the 25% depreciation recapture tax, and that would actually give us a tax of $25,000. All right, now, how much is left? $475,000. Right, so we'll take the, let's just say we're at the highest capital gains tax rate of 20%. So we'll take that $475,000, multiply it times the 20% capital gains tax rate, and that would give us a tax of $95,000. All right. Now, let's also say we're going to be subject to the Medicare tax. All right. the 3.8%. So we'll take the 475,000, multiply that times the 3.8%, and that would give us a tax of $18,050. All right. So when we sell this property, we'd actually be looking at a tax bill of $138,050. All right. Now again, when you do a 1031 exchange, you can defer having to pay any of these taxes. All right. Now, for those of y'all that are on the line that are realtors, all right, if y'all think about this for a minute, if that's your client, okay, and your client is sitting there thinking they're going to have to pay $138,050 in taxes, and then whatever's left over, hey, now let's go out and find me some replacement property, right? Well, if you're the one that brings it to the table and you'd say, hey, that check you're going to have to cut for $138,050, do a 1031 exchange, defer all those taxes. Now let's go out and find you something better, right? Well, that's going to make you look pretty good to the client, right? And what else is it going to do for you as a realtor? Well, hopefully you just increase your commissions, because now if the client can go out and buy a better property, hopefully it's going to be a higher dollar property, right? Well, you just increased your commissions. So, it's a win-win situation all around, right? The client wins because they save on the taxes. They get a better property. Hopefully it's a better income producing property. And then you win because why? Well, because you look like a rock star, right, to the client, and you just increased your commissions, all by recommending a 1031 exchange. All right. Now, what am I not listing in this number, right? This $138,050. You got to remember state income taxes. All right. So again, if you live in a state that has state income taxes, you'd have to calculate that in as well. All right. It's probably even more worth your while to do a 1031 exchange if you live in a state that has state income tax, or even if you're selling a property that has state income taxes. All right. So let's talk a little bit about some of the tax advantages when you sell real property. All right. So with 1031 exchange, let's just reiterate what a 1031 exchange is. We covered this in the basics class, but you can only do a 1031 exchange on real property that you use in your trade or business, or that you hold for investment, all right? And you can only replace it with other real property. It's referred to as like-kind property, other real property that you use in your trade or business, or that you hold for investment, okay? That like-kind property can be any type of real property. All right, regardless if it's commercial or residential, if it's a single family, if it's a warehouse, it doesn't matter. As long as what you're holding, as long as what you're selling, you're using it in your trade or business, or you're holding it for investment, and as long as what you're replacing it with, you're using it in your trade or business, or you're holding it for investment. All right, and it's a tax deferral. We've already talked about that, right? Tax deferral. Why? Because you may have to pay the taxes someday if you don't continue to do 1031 exchanges, right? But remember the step up in basis that we talked about, right? If your heirs inherit the property, well, no one ever has to pay the taxes, all right? So that's for investment property, or property that you use in your trade or business. Now, what about your primary residence? Can you do a 1031 exchange on your primary? And the answer is no, okay? For your primary, you may actually qualify for what they refer to as a Section 121, right? And the way that works is you had to have lived in the property for at least 2 years as your primary, right? When you go to sell that property, if you have any gain in the property, all right, if you're single, the first $250,000 of any gain is tax exempt. If you're married, the first $500,000 of any gain is tax exempt. Now, tax exempt meaning that you never have to pay it. All right, it's not like a deferral, a 1031, where it's a deferral where you may have to pay it someday. But with the 121, it's basically you're one and done. All right, you'll never have to worry about paying those taxes again. All right, now here's a quick example of how the 121 works. Let's say we buy a property in 2010. All right, now we're going to buy it for $100,000, and we're going to live in it as our primary for 5+ years. And then we're going to turn around, we're going to sell the property in 2016. All right, now we're going to sell it for $1 million. And I know, everybody, that's a great deal, right? We bought it for $100,000. We're selling it for $1 million. I don't know if there's any properties like that in the Tampa area, but maybe maybe if you're listening in from California or maybe New York, hey, maybe y'all have some properties like that. All right, but we're going to keep the numbers really simple. All right, so we're going to sell the property for $1 million. We bought it for $100,000. Right. Now our gain's $900,000. Now we know that's not exactly how you calculate it, right? Because we just went over the example. You got to figure out adjusted basis and everything else. But let's just keep it really simple, all right? So our gain's $900,000. Right now, it qualifies for 121 because we've lived in it for at least 2 years as our primary. All right. Now we're married as well. So the first 500,000 of the 900,000, we're going to claim this section 121, and that portion of the gain, the first 500,000, can be tax exempt. All right, but the problem is we still have another $400,000 worth of gain that we have to pay taxes on. All right, that's going to equate to about $130,000 in taxes that we have to pay when we sell the property in 2016. Now, what if we could do this? What if in 2016, excuse me, we could actually turn the property over and convert it to an investment property, to a rental property, all right? Now, let's say we rent the property out for 2 years after we convert it over, right? And now we're going to sell the property in 2018. Now, we're still going to sell it for $1 million because, right, we're going to keep the numbers simple, right? But now, because we're selling it and it's an investment property, it now qualifies for 1031 exchange, all right? So we can actually do a combination of the 121 and the 1031, all right? In order to do that, you had to have owned the property for at least 5 years, all right? You had to have lived in the property any 2 out of those 5 years, all right? So, again, we're married, all right? So we're going to claim the 121 on the first 500,000 of that $900,000 gain, all right? And now the additional 400,000, we're back in 2016, we're having to pay the taxes on that amount. Well, now we can claim a 1031 exchange on that portion of the gain, all right, and defer that 400,000 in gain, all right. And now in 2018, we pay no taxes. Okay, pretty cool, right? Now here's another way you can do it. What if you want to go out and you want to buy a fourplex? Let's say you want to live in one of the units as your primary, but the other 3 units, you want to rent those units out. That's going to be the investment portion. Same thing, when you go to sell the property, did you own it for at least 5 years? Did you live in it for 2 out of the last 5 years, of any of those 5 years, all right? If you did, you can do the combination. So 1/4 of the gain, you could claim the 121. 3/4 of the gain, you could claim the 1031 exchange on that portion of it and defer that portion, right? It can work the same way. What if you want to go out and you want to buy a duplex, a double, right? You want to live in half of it. You want to rent out the other half. Okay, when you go to sell it, did you own it for at least 5 years? Did you live in it any 2 out of the last 5 years as your primary? If you did, you can do the combination of the 121 and the 1031. All right? Now, who can actually do a 1031 exchange? Well, with exchanging, all right, whoever the taxpayer is in the sale of the relinquished property, all right, must be the same taxpayer in the purchase of the replacement property, all right? So individuals can do 1031 exchanges, all right? Husband and wives, spouses, well, who else? Individuals, right? Husbands and wives. Sometimes this happens with the spouses, all right? Let's say one of the parties actually owns an investment property prior to being married, all right? So let's just say it's the wife, all right? So she owns a rental property, an investment property. It's a rental property, right? Prior to being married. So she gets married, right? And then during the course of the marriage, she decides she wants to sell that rental property. All right, and she wants to do a 1031 exchange to defer her taxes, all right? She wants to buy another investment property, but in order to buy that investment property, she has to get a mortgage, all right? And in order to qualify for the mortgage, she needs her husband's income, all right, to be able to qualify for the mortgage. So how can you do that? Well, There's a type of ownership that it's referred to as tenants in common tenants in common ownership, all right? For those of y'all on the line that don't know what tenants in common ownership is, you can actually own a certain percentage of a property, all right? So with the example with the husband and wife, you might be able to bring the wife in as a 99% tenant in common owner, and then you bring the husband in as a 1% tenant in common owner. Now, all of this is going to be dependent on if the lender will actually go for that, right? If they will accept that as to meet their loan requirements, right? If the lender is an acceptance of that, then hey, you can get the loan and move forward and buy the replacement property. All right, now that brings me to the next point. Tenant in common owners can do 1031 exchanges. All right, I'll give you guys an example. Let's say I want to go out and I want to buy an investment property, all right? But I want to bring somebody else in with me to help me buy that investment property, all right? And we're going to be tenant in common owners, all right? So I'm going to own 50% of the property and he's going to own 50% of the property, all right? Now, we buy this property as tenant in common owners, right? It's an investment property and we hold on to that thing for years, all right? Now, at some point, we decide, hey, we want to sell the property. Now, for me, I'd like to take my 50% tenant in common ownership, do a 1031 exchange, and buy some investment property, some replacement investment property. But my other tenant in common owner, he says, you know what? I have no desire to to go out and buy any additional investment properties. I'm fine with just cashing out and paying whatever taxes are due. Well, he can do that, okay? And I also have the option to do what I want to do. If I want to do my 1031 exchange and defer my taxes, buy a replacement property, I can do that as well. He could even do his own 1031 exchange if he wanted to, defer his taxes and go out and buy replacement property, all right? So tenant in common owners can do 1031 exchanges. Any type of legal entity that owns real property can do a 1031 exchange, okay? Corporations, partnerships, trust, LLCs, okay? Sometimes we see this with LLCs. Sometimes you may have what's referred to as a disregarded entity, okay? A disregarded entity, meaning that the actual entity doesn't file a separate tax return, all right? You just put everything on your personal taxes, all right? Most common is you'll have like a single member LLC, all right? That single member LLC is disregarded, meaning that it doesn't file a separate tax return. Like some of y'all on the line that are realtors, it's really common for realtors to have an LLC for their real estate business, okay? And it's disregarded because at the end of the year, you don't file a separate tax return for that LLC. You just put anything to do with that LLC on your personal taxes, all right? So in that case, your disregarded LLC, disregarded entity, is one and the same as you as an individual, all right, for tax purposes. So with 1031 exchange, okay, let's say you sell a property as an individual. Well, the replacement property can be in your name as the individual, or it could even be in the name of your disregarded LLC, your disregarded entity, all right? It can work the opposite way as well. If you have a disregarded entity like that single member LLC that sells the real property, all right, the replacement property can be in the name of that disregarded LLC, or it can be in the name of the individual, all right? Because why? Because for tax purposes, they're all one and the same, the individual and the disregarded entity, all right? Now, if you have what's referred to as a regarded entity, like a multi-member LLC, a partnership, a corporation, okay, where the actual entity files a separate tax return, well, if that entity sells the real property, okay, in a 1031 exchange, well, the replacement property needs to be in the name of that entity, that regarded entity. All right. Sometimes we see this with, like with partnerships, for instance. Sometimes when a partnership will sell, okay, the different partners have different ideas, different goals, all right? You may have one partner that says, well, you know, when we sell, I think we should do a 1031 exchange to defer our taxes and buy some replacement property. But, you know, you might have another partner that says, you know what, I don't think we should buy any replacement property. I don't think we should do a 1031 exchange. I think we should just cash out and pay whatever taxes are due. All right. But again, how can you do that? Because why? Because whoever the taxpayer is in the sale is going to have to be the same taxpayer in the purchase of the replacement property. All right. So here's two solutions. Okay. Now, these are actual terms that we use in the industry. Okay. The first one's referred to as a drop and swap. Okay, then the drop and swap can work something like this. Let's say we have a multi-member partnership. All right, let's say we have three partners or a multi-member LLC, whatever it may be. Let's say we have three partners. Okay, now what happens in the drop portion of the drop and swap? Okay, the partnership owns the real property. Well, what they do is the actual partnership will be dissolved, will be dropped, okay? And I said we had three partners, right? So they change the ownership structure of the property and they become tenant in common owners, all right? So the former three partners now basically each one of them are going to own a third of the property, all right? Now, as tenant in common owners, they're going to have to hold on to the property probably for a year or two. Why? Because you have to be able to show that you're holding the property for the intent of investment, okay? We talked about that in the first class, the basics class. You have to show that your intent is to hold the property for investment. So it's going to probably take about a year or two. Now, after the year or two passes, then you can do the swap. Then you can sell the property, okay? And each tenant in common owner can do what they want, okay? One wants to do a 1031 exchange to defer their taxes, buy another replacement property, they can do that. You have another tenant in common owner that just wants to cash out and pay his taxes, he can do that as well. All right. Now, the opposite of a drop and swap is referred to as a swap and drop. All right. The swap portion can work something like this. All right. You still have that three-member partnership, right? So what happens is the partnership owns the real property. The partnership will sell the real property in a 1031 exchange, all right? Now, the replacement property that the partnership goes out and buys, instead of buying one property, the partnership goes out and buys three replacement properties. Why three? Because they have three partners, right? And the thinking is, each partner is going to have a kind of a say in what properties they buy, right? Now, once the partnership buys those three properties, the partnership's going to have to hold on to the three properties probably for a year or two. Why? Because the partnership needs to show that they're holding the properties for investment, okay? And after the year or two passes, then they do the drop. Then they dissolve the partnership, and then each partner gets one of those properties. All right. Now, with either one of these examples, right, it's going to take some time, right? It's probably going to take a year or two before everything gets resolved. Now, sometimes what we see with partnerships is the partners aren't getting along to start off with, okay? They can't stand each other, right? They have to have some type of agreement with either one of these scenarios that they're willing to get along with each other probably for another year or two, right? Again, that's not always the case, all right? Sometimes the partners, that's the whole reason they're selling everything is because, hey, they can't stand each other anymore, all right? So there has to be some type of agreement that they're willing to at least deal with each other for the next year or two once everything gets resolved, either doing the drop and swap or the swap and drop, okay? So that's partnership issues that we see. Now, 1031 exchange guidelines. All right, the basic requirements. We're gonna recover the property qualifications. All right, for those of y'all that didn't join in on the basics class, we're going to talk about some of the tax deferral requirements. We're going to talk about some timelines everybody needs to be aware of, and we're also going to talk about some identification rules. All right, so to recap, you can do a 1031 exchange on any type of real property that you use in your trade or business or that you hold for investment, okay? You can exchange it for any of the type of real property that you use in your trade or business or that you hold for investment, okay? That's referred to as like-kind property. All right, so just because you have that single-family residential home, right, that you hold for investment, that rental property, When you sell that in a 1031 exchange, you don't have to replace it with another single family. You can if you want, or you could replace it with any other type of real property. You could replace it with a condo, a duplex, a fourplex. You could replace it with vacant land, okay? You could replace it with a commercial strip shopping center, a commercial warehouse, a downtown commercial office building in any major metropolitan city in the United States, okay? Any type of real property that you hold for investment or that you use in your trade or business, you can exchange it for any other type of real property that you use in your trade or business or that you hold for investment, okay? The properties can be located anywhere domestically in the United States, including Guam or the U.S. Virgin Islands, okay? Puerto Rico is not included in that number, all right? Now, what property is excluded from 1031 exchange? All right, your primary residence. We've kind of already talked about that, right? What do you potentially do for your primary? That's section 121, right? So your primary is excluded. Now, property held for sale, what exactly is that? Well, property held for sale, let's just say I'm a builder, okay? In the state of Florida, at least, we have a lot of these national home builders like Pulte Homes, Lennar Homes, KB Homes, all right? Let's say I'm Pulte Homes, right? So Pulte Homes, they build properties all over the United States, right? Newly constructed properties all over the United States, multiple states, right? Now, the properties that they complete, when those properties are completed, what do they do with them? Well, they turn around and sell them, right? Because those properties are being held for sale and they're not being held for investment, they can't do 1031 exchanges on those types of properties, all right? Because again, they're holding those properties for sale. They're ineligible, all right? Dealer property. Now, dealer property may be somebody that we most often refer to as a flipper. You know, they come in, they buy a property, I don't know, 2 or 3 months goes by, they fix it up, and then what do they do with it? Well, they turn around and sell it, right? Okay, because they're holding those properties for sale, they can't do 1031 exchanges on those types of properties, all right? Because that's like their business. That's like their inventory, okay? That's the business that they're in. They fix properties up and they turn around and sell them, okay? You can't do 1031 exchanges on those types of properties. Now, if I'm a flipper, let's say I fix up a property, 2 or 3 months goes by, I fix it up. Instead of turning around and selling it, let's say they go to their realtor and say, hey, can you put this in the MLS system and show it for rent? Let's also put it in there for fair market value rent. That's a little different, right? Because why? Because now all of a sudden they're showing their intent that they're holding it for investment and they're not holding it for sale, right? Who knows? Maybe they show it to a potential renter, right? Maybe they never rent the property out. You know, they run a credit check on that potential renter. They have horrible credit and they decide not even to rent the property to them, all right? Again, you have to be able to show your investment intent. We've talked about that in the basics class, all right? If that flipper were to get audited, all right, if they did a 1031 exchange and would get audited, and the IRS would come in and say, hey, prove to us that you held that property for investment and you didn't hold it for sale, they'd have to be able to back it up. In an example I gave you, they could easily back it up, right? They could say, look, here's an email I sent to my realtor saying I wanted to put it in MLS for rent. Here's the day it went into the MLS service for rent. Here's the MLS listing. Here's the day I showed it to a potential renter. Here's when we ran the credit report. All of that type of stuff, okay, is going to be their ammunition, is going to be their trail of breadcrumbs to prove that their intent was to hold the property for investment and was not hold it for sale, all right? Again, if they just fix the property up and turn around and sell it, can't do a 1031 exchange on it, all right? Foreign property. Now, this is foreign property is excluded. I couldn't do a 1031 exchange on property located in the United States, okay, and then try to replace it with property located in Canada or Mexico or somewhere in Europe, right? It has to be what? Domestically located property, all right? Anywhere in the United States, including Guam or the U.S. Virgin Islands, all right, as the replacement. All right? Again, Puerto Rico is not included in that number. All right, so guideline number 2. So in order to get a full deferral, rule number 1 is you must reinvest all of the net proceeds in property of equal or greater value, all right? What are the net proceeds? The net proceeds, that's the cash, all right? That's the cash that normally you would get out of the closing, all right? Now, we're the qualified intermediary, all right, the QI. We're going to hold those proceeds on behalf of the seller, the exchanger, all right, because they can never actually have receipt of those funds. If they do, they lose their ability to do a 1031 exchange, all right? So, they couldn't close today and call me on Monday and say, hey, Jeff, I want to do a 1031 exchange. At that point, it's too late, all right? Once you receive the funds, that's it. You're paying your taxes. You've lost the ability to do a 1031 exchange, okay? They couldn't even close today. Let's say in the parking lot, they call me from the parking lot of the escrow company, title company, attorney, whoever it may be that did the closing, that their funds may be sitting in their escrow account of the party that did the closing. They may be waiting to wire the funds out to them, okay? They still have lost their ability to do a 1031 exchange, all right? Because at that point, they have what's referred to as constructive receipt, all right? They have a legal right to the funds, or they've lost their ability to do a 1031 exchange, all right? So we have to get involved prior to the closing, okay, before they sign on the dotted line, basically. So we hold those proceeds on their behalf, all right? Now, they have to take that entire amount and they have to go out and they have to buy a replacement property, or it can even be a combination of properties where the total purchase price is going to be equal to or greater than whatever the sales price was on the property that they sold, all right, the relinquished property. That's rule number one. Rule number two is if they have any debt, okay, you must acquire an equal amount or greater debt. Now, what exactly does that mean, right? If you have a loan that you're paying off, all right, you must obtain a loan equal to or greater than whatever that payoff was, all right, in any replacement property or properties. All right, now that rule can actually have an exception. If you have cash that you can add to the closing on the purchase of the replacement property, you can avoid having to acquire any additional debt, all right? Now, obviously, if you don't have a loan that you're paying off, if you have no debt, well, you're not required to obtain debt on the replacement property, but you do have the option. If you need to get a loan, you can always do that. All right, that is an option to do that. All right, now, how do the numbers work? All right, so here's a quick example. All right, in our example, we're going to sell a property. We're going to sell our property for $1 million. All right. Now, we'll take that $1 million sales price. All right. Now, we have a loan that we're going to be paying off. We have debt that we're paying off of $300,000. So we take that $1 million sales price, minus out the payoff for the debt, the loan that we're paying off of $300,000. Now, we have some cost of sales. All right. That's going to be, let's say that's going to be $50,000. Now, that's going to be like real estate commissions, title insurance, closing costs, closing fees, that type of thing. A lot of those non-reoccurring type of closing costs. Let's say that's $50,000. So we'll take out the $50,000, right? And that would give us net proceeds of $650,000, all right? Now, we're the qualified intermediary, the QI. We're going to hold that $650,000 on behalf of the seller, the exchanger. All right, now what are they going to do with that $650,000? Well, they're going to take that entire amount, and now in our example, they're going to go out and buy a property for $1.2 million. So they actually are going up in value, right? Because they sold the property for $1 million, but they're acquiring their property for $1.2 million. All right, they're going to take that entire $650,000 and help them buy. That's going to help them buy that property for $1.2 million. All right, so they just met rule number one. All right, because why? Because they used the entire net proceeds of $650,000, and they actually went up in value. They're acquiring a property for $1.2 million, right? Because they sold for $1 million, so they're actually going up in value. Now, they also need another $550,000 to help them buy that replacement property for $1.2 million, right? So what do? Well, they go out and get a loan for $550,000, all right? So by getting a loan for $550,000, they actually just met rule number two, all right? Because they had a loan of $300,000 they paid off, and now they're actually acquiring greater debt because they're getting a loan for $550,000. So in our example, we would get a full deferral. Okay, we would defer our taxes 100%. Okay, now what if they wanted to do this? What if they said, well, I don't want to get a loan for $550,000. I happen to have $550,000 cash that I can add to the closing on the purchase of the replacement property. Well, they could have done that. Okay, they would have still met rule number 2 because what did I say? There's an exception. If you have cash that you can add to the closing, you can offset having to acquire any debt. Now, they could have done this too. They could have said, well, we only want to get a loan for $200,000. All right. The rest we'll make up with cash. Well, they could have done that as well. All right. So that's how you get a full deferral, 100%. Now, what if you wanted to do this? What if out of that $650,000 you say, well, you know what? We don't want to use all that towards buying replacement property. We want to take $100,000 of that money and we want to put that in our pocket. All right. And we only want to use $550,000 towards buying replacement property. Well, that's $100,000 that you put in your pocket. You can do whatever you want with. Right? You want to pay off bills. You got a child starting college. You want to pay for college. You want to go on a great vacation. Hey, who knows? You want to go to Vegas. You want to blow it all gambling. All right. You can do whatever you want with that $100,000, but you're going to be subject to tax on that amount. All right. It's referred to as cash boot. All right. Now, it doesn't mean you can't do a 1031 exchange. Okay. It just means that instead of getting a full deferral, you're going to get what's referred to as a partial deferral. Partial, why? Because you're going to be paying some taxes on the boot. All right. So back to the example. So you take the $550,000. Now we're going to hold it because we're the qualified intermediary, right? You take that $550,000 and now they go out and they buy a property of less value. They only buy a property for $800,000. All right. Now they still need another $250,000 to help them buy that property for $800,000. So what do? Well, they go get a loan for $250,000. All right. But now, by only getting a loan of $250,000, they actually acquire less debt. All right. They acquire $50,000 less debt than what they had, right? Because they had a loan of $300,000 they paid off, and they're only getting a loan for $250,000. So that $50,000 of less debt, they're going to be subject to tax on that amount. All right. That's actually referred to as mortgage boot. All right. So there's two types of boot. There's mortgage boot and there's cash boot. All right. Again, it doesn't mean you can't do a 1031 exchange. It just means that you're going to be paying some taxes. All right. You're going to get a partial deferral rather than a full deferral. Now, if anybody ever wants to do this, okay, I always tell them and say, look, talk to your CPA and you really need to get all of your numbers. All right. Because you have to look at it and say, well, if I sell the property outright and I don't do a 1031 exchange, what's my tax situation look like? But if I sell the property and I do a 1031 exchange and I pay some taxes on the boot, what's my taxes look like? All right. Now, typically those taxes are going to be less than just selling the property outright. But if the CPA comes back and says your taxes are actually going to be greater if you do the 1031 and you pay taxes on the boot, then you know what? Don't do a 1031 exchange, okay? It's not going to be worth your while to do it. You're going to lose money, all right? So remember, cash boot and mortgage boot, all right? Now, there's some timelines everybody needs to be aware of, right? So from when you sell your relinquished property, all right, you're going to have 180 calendar days to purchase any replacement property or properties, all right? Now, that's calendar days. That's holidays. That's weekends, okay? Hey, the people that live in Florida, right, and all up and down the East Coast, certain times of the year we're susceptible to hurricanes, right? Well, if we're getting hit with a hurricane and everything shuts down for a day or two or a week, whatever it may be, it does not matter, all right? That clock is still ticking, right? So it's 180 days to close to purchase any replacement property or properties. Now, the first 45 days of the 180, that's referred to as the identification period, all right? Now, what exactly does that mean? Well, the identification period means that you must identify any potential property or properties that you want to buy. All right, that's something else we're going to assist with. Okay, we're going to provide to the client our identification ID letter. All right, and on that form, there's going to be blank lines, and it's going to have to be specific to a property address or addresses. All right, they're going to have to sign off on that, get it back to us by midnight of the 45th day. That's how you formally will identify your replacement properties. You identify to us, the qualified intermediary. Now, those properties, they don't even need to be under contract, okay? But the thing is, let's say you find the perfect property on day 46. Well, at that point, it's too late, okay? So whatever you put on that form, you're going to have to make sure you're going to be able to buy at least one of them, all right? Because there is no options after midnight of the 45th day. There's no options to change anything that was on that form, all right? If one of those properties gets sold, let's say you identify 3 properties, one gets sold, one burns down to the ground. If it's after midnight of the 45th day, you only have the opportunity to purchase that one other property if you've identified 3, okay? So very important to remember the timelines. 45 days to identify, but you have a total of 180 to purchase the replacement property, all right? For those of you all on the line that are realtors, okay, why is that 45-day great for you guys? All right, because your client needs to make a decision within 45 days, okay? They're not going to be you're not going to be spending days and weeks and months on end showing them property. You need to figure out, or the client needs to figure out what they want to buy 45 days after they sell their relinquished property. Okay? All right, so 45 days to identify, a total of 180 to purchase the replacement property. If you're purchasing your replacement property on day 181, you're paying your taxes. Okay? If all the properties that you've identified after midnight of the 45th day, if you cannot acquire any of those properties, you're paying your taxes. Okay? All right, so let's talk about some of the, there's some rules to actually identifying replacement property. Now, there's 3 different rules, okay? Now, I'm going to read each one of these rules to you. And when I read them to you, if you don't quite understand how they work, don't worry about it, because I have 3 examples. I'm going to show you how the numbers work with all 3 of these rules, all right? So don't worry about it. Hopefully once I give you the numbers or show you the numbers, it'll make sense, all right? So the first rule is referred to as the 3-property rule. Now, this is the most popular rule that we see. Probably, 90 to 95% of all the exchanges that we do fall under this first rule, all right? And the 3-property rule states this. You can identify up to 3 properties without regard to the fair market value of those 3 properties. So what exactly does that mean, right? Well, if you identify 3 properties or less, the purchase prices of any of those properties can be any dollar amount. It doesn't matter. As long as it's 3 properties or less, it can be any dollar amount what you're purchasing them for, okay? Now, if you want to identify more than 3 properties, you can do that, all right? But you're going to fall into this next rule. It's referred to as the 200% rule, all right? And what that means is you can identify over 3 properties, but then you cannot exceed 200% or 2 times the combined fair market value of the property being sold. So what exactly does that mean, right? Well, if you identify more than 3 properties, okay, the combined purchase prices of all those properties that you've identified cannot exceed 200% or 2 times whatever the sales price was on the property that you sold. All right. And again, if you don't understand that, don't worry about it. I'm going to show you the example. All right. Now, if you want to identify more than 3 properties and you also want to exceed the 200% rule, you can do that. Okay. But you're going to fall into this next rule, all right? It's referred to as the 95% rule. Now, this rule doesn't make a lot of sense, guys. It's rare that we even see that this rule is enacted, but I just want everybody to realize it does exist, okay? And again, it doesn't make a lot of sense, but remember, hey, this is the IRS, right? And sometimes this stuff just doesn't make sense, all right? So here's how it works, all right? You can identify over 3 properties. You can exceed the 200% rule, but you must acquire at least 95% of the value of all the properties that you've identified. All right, now, again, that's probably about as clear as mud, I'm sure, from some of y'all. All right, let me show you all the examples, and hopefully it clears it up, especially the 95% rule. All right, so here's the 3-property rule. Again, if you identify 3 properties or less, okay, the purchase prices can be any dollar amount. So here's an example, all right? So we sell for $1 million. Now we go out and we identify 3 properties, right? So we're in the 3-property rule. Now let's just say we're going to be buying each one of them for $1 million, all right? So we've identified $3 million worth of property. Now with the 3-property rule, it doesn't matter what the purchase prices are. We could be buying each one of them for $10 million a piece, for a total of $30 million in identification, okay? Again, 3-property rule, it can be any dollar value, all right? It doesn't matter. But what does matter, okay, I'll say it again. If you identify 3 properties, you better make sure you're going to be able to buy at least one of them, okay? So what's the best way to lock up a property? Well, it's to put one of them under contract, okay? So that's typically what we see is somebody will put one property under contract. That's one of the properties that they identify. And then maybe they'll identify 2 additional properties, okay? Because if after midnight of the 45th day, if the one that they have under contract, if that whole contract falls apart, at least they have the ability to buy those 2 other properties that they've identified, okay? Because the best way to lock up a property is why? Is to put it under contract. So that's what we see, okay? So there's the 3-property rule. Now, here's the 200% rule. This is where you exceed the 3-property rule, all right? But then you cannot exceed 200% or 2 times the combined fair market value of the property that you sold, all right? So here's how it works. All right, we sell for $1 million, all right? Now we go out, we identify 5 properties, all right? Because we've identified 5, we've exceeded our 3-property rule, right? So that puts us into the 200% rule. So what exactly does that mean, right? Well, what that means is the combined purchase prices for all 5 of those properties cannot exceed $2 million. Now, where's that $2 million coming from, right? Well, we sold for $1 million, right? 200% of $1 million that we sold, or 2 times $1 million that we sold, is $2 million, right? So that's how the 200% rule works. Hopefully that you get it, right? It's pretty straightforward, pretty easy concept to remember, all right? Now, here's the 95% rule. All right, this is where you want to exceed the 3-property rule, and you also exceed the 200% rule, but you must acquire at least 95% of the value of all the properties that you've identified, all right? So here's how it works. We sell for $1 million. Now we go out, we identify 10 properties, okay? So because we've identified 10, all right, we've exceeded our 3-property rule. Now let's keep the numbers really simple. Let's just say we're going to buy each one of them for $1 million, all right? So we've identified $10 million worth of property, right? Because we've identified $10 million worth of property, we've just exceeded our 200% rule, right? Because that number was how much? It was $2 million, all right? So that puts us into this 95% rule. Now, in our example, if we only acquire 9 out of the 10 properties, that's only 90%, or $9 million, right? That's not 95%. If we do that, if we only acquire 9 out of the 10 properties, we blow our entire exchange and we have to pay all of the taxes, okay? So the reality of the 95% rule is really 100%, okay? Whatever you identify, you're going to have to buy. All right, and we're using really simple numbers. We're just saying, hey, everything's going to be even $1 million. You know what? Those purchase prices are going to be all over the map, all right? It's going to be really hard to sit down and say, well, okay, let's see. If I get this property, wait, that's only 93%. All right, maybe I need to get this other property. Ooh, that's only 94%, all right? The reality of the 95% rule is 100%, all right? The IRS wants to limit you in how many properties you can identify, okay? They don't want you identifying everything under the sun, okay? Because why? Because if you identify everything under the sun, guess what? you're going to have to buy everything under the sun because of this crazy 95% rule. All right. So hopefully y'all understand that concept. All right. Now let's talk a little bit about some other types of exchanges. So, the most common type of exchange that we see is referred to as a delayed exchange, right? That's everything we've talked about today. That's where you actually buy first, you sell first. So you're selling your relinquished property, right? Clock starts ticking, 45 days to identify, and you're purchasing last. You're purchasing your replacement property by day 180. That's called a delayed exchange. That's the most common type of exchange that we do. 90 to 95% of all the exchanges we do are delayed, a delayed exchange, all right? But there's another type of exchange out there. There's a few different types, actually. There's one that's referred to as a reverse exchange, all right? It works just the opposite of a delayed. It's actually where you buy first, then you sell last, okay? They can work something like this. Let's say you have your property listed for sale. Now, you don't even have a contract on it yet, right? But you go out and you find the perfect replacement property, all right? Now, let's say it's a seller's market, all right? And properties are turning over fast, right? And you're going to have to be able to act fast too if you want to be able to buy that perfect replacement property, right? Because it may be sold. So what can you do? Well, you can do this thing called a reverse exchange. What happens in the reverse is we actually come in and we form a separate company. We form an LLC. It's also referred to as an exchange accommodating title holder, EAT for short. We come in and we buy the replacement property before you sell your relinquished property. All right. When we do that, you must be able to sell your relinquished property within 180 days. All right. So there's the 180 coming back into play. All right. Now, what are some of the positives for a reverse exchange? All right. As I mentioned, in the seller's market, you have to act fast. You want to be able to get that perfect replacement property. It's perfect for that situation. What if you did this? What if the client listed their property, all right, and they thought, gosh, my property is the greatest property in the world, right? I'm not going to have any problem selling it. So what do? Well, they go out and put a contract on a replacement property. And then you know what? Slowly but surely they realize maybe they don't have the perfect property. Maybe they don't have the greatest property in the world. Because why? Because they're not getting all the showings that they thought. They're not even getting all those offers like they thought, right? But guess what? They already have a contract on a replacement property, and that closing date is fast approaching. They need to do something, right? Because they're obligated to buy that replacement property. Well, they can do the reverse exchange and save the whole deal. Now, what's some of the negatives? What's the biggest obstacle to overcome in a reverse exchange? Hey, we're a great company, right? But we're not just going to come out of pocket and buy the replacement property, all right? That exchanger needs to be able to give us the financing to be able to do that, all right? Typically, it's going to have to be cash. Now, why do I say it has to be cash? Because if they're trying to get a loan to buy that replacement property, conventional lenders are not going to loan funds at that point, okay? We're not the borrower, they are. We're going on title, they aren't, okay? So traditional lenders are not going to loan funds at that point. Now, maybe they have a great banking relationship, right? They can get some type of line of credit, okay? Some people tell me some of these hard money type lenders will loan funds like that all day, all right? But it doesn't really matter to us. Just some way, somehow, they're going to have to be able to give us the financing to be able to buy that replacement property, all right? Now, what's the other negative? Well, you have to be able to sell your relinquished property within 180 days. What happens if you don't sell your property in 180 days? Well, at that point, you're going to own two properties, okay? You're not going to have to pay any taxes because why? Hey, you never sold anything. You don't have any gain. You never sold anything, right? And if you ultimately want to sell that property you were trying to sell, you can still do that, okay? But you're going to have to do an exchange, and you're going to have to designate a different replacement property. Why? Because you can't exchange into something you would have already owned, okay? And you would own that replacement property that we would have purchased in the prior, okay? So that's how a reverse exchange works. Now, there's another type of exchange. It's referred to as a construction, improvement, built-to-suit exchange, okay? They all can kind of work like the same way, something like this, okay? Let's say you sell your relinquished property, all right, in a 1031 exchange, all right? Now, we're the qualified intermediary. We're going to be holding those proceeds from that sale, right? Now you go out and you find a replacement property, but it's not everything you want. You want to do some improvements to it before you actually acquire the property. Well, you can do this thing called the construction exchange, built to suit, improvement exchange. All right. What happens is we come in again and we form that LLC, that EAT. We can take the proceeds that we're holding from the sale, and then we use those proceeds to buy the replacement property. All right. Then we oversee any construction. Okay. We're working with the contractors. We're handling disbursements. We're paying those contractors, the whole boat. Okay. Now, those improvements need to be done within 180 days. All right. So there's the 180 coming back into play. It never goes away, right? That's where the 180 comes back into play. You have to have those improvements done within 180 days. All right, there's another type of exchange. Now, sometimes we see there someone will say, well, you know what? I bought my property in the height of the market. Now I've owned that thing for years, and I'm going to sell it, and I'm selling it for basically what I bought it for. So on the surface, they may say, well, I have no gain. I don't need to do a 1031 exchange. All right. But y'all remember that depreciation recapture tax, that 25% tax that we talked about earlier? Well, any depreciation that they've claimed on the property for the entire time that they've owned it, they're going to be hit with the 25% depreciation recapture tax just on that depreciation alone. All right. So here's a quick example. Let's say they bought the property for $1 million. Again, they've owned it for years, and now they're going to turn around, they're going to sell it for $1 million. All right. But the problem is, for the lifetime that they owned it, they've taken $200,000 of depreciation. So when they go to sell that property, all right, they're going to be hit with a 25% depreciation recapture tax on that $200,000. That's going to equate to $50,000 in taxes when they sell that property. All right, so if you ever have a client that is telling you this, I always tell people to say, look, make sure you talk to your CPA. Just make sure you know your numbers, because hey, you don't want to have the realization after you close that, gosh, I had to pay $50,000. They could have still done a 1031 exchange and deferred the depreciation recapture tax. Okay, realtors on the line. If you ever have a client that tells you, "Hey, I bought this property via 1031 exchange funds," right? And if they're not doing a 1031 exchange on that sale, they may need to, right? Because remember, it's a tax deferral. It's not a tax avoidance. They'd be responsible for the taxes that are due when they sell that property, but any of those other taxes that they deferred prior, they would also be subject to having to pay those taxes, right? Sometimes this happens too. Somebody will say, hey, I bought this property in a 1031 exchange, with 1031 exchange funds, but now I'm selling at a loss. I don't need to do a 1031 exchange. Well, not necessarily, okay, because the losses that they have in that transaction may not overcome the deferrals that they did in the past, all right? So always talk to your CPA, right? Because your CPA is going to have all that information to be able to advise you on what you need or need not do, okay? So last slide. All right, we're just about out of time. We're supposed to finish up at 12:15. We're right there. As far as our fees go, well, on a delayed exchange, okay, again, that's the most common type of exchange. That's where you sell first. You're selling your relinquished property, right? 45 days to identify, and you're buying your replacement property by day 180. That's a delayed exchange. So we charge $750 on the sale. All right, we don't collect anything until it physically closes. All right, we're like a lot of the other parties in that transaction where we don't earn our fee until it actually closes. All right. If for some reason it doesn't close, if the contract falls apart and we've done all the work, well, we don't charge any kind of cancellation fees. All right. We don't even charge any type of wiring fees, junk fees, anything like that. Our $750 is charged the day of closing at the closing. All right. So we charge $750 on the sale. And when you purchase the replacement property, that's when we charge $200. That's our other fee is $200 on the purchase of the replacement property. All right. So if you sell one property and you buy one property, our total fee is $950. All right. If you buy a second property, if it's a separate closing, a separate seller, we're dealing with a different company, title company, attorney that's handling that transaction. Well, that's another $200. All right. So that's a delayed exchange. Now, the reverse exchanges, the construction, the built to suit, the improvement exchanges. All right. Our fees start off at about $6,500 for those types of exchanges. All right, they can be significantly more complicated. All right, we're forming a separate company. We're going on title with the construction exchange. We're working with contractors, the whole boat. All right, but they start off at about $6,500. Okay, so we're done. I'll open the floor up to questions. If anybody has a question, go ahead and type it into that the box on the right-hand side. And while we're waiting for the questions to come in, again, everybody, you should receive a link to today's webinar, the presentation. Also, as I mentioned in the very beginning, a lot of what we talked about today, I have in PDF form, okay? Various topics that we talked about. If you want those PDFs, please just send me an email and let me know, all right? I'd be glad to email those over to you, especially if you have clients that have 1031 exchange needs. Most people tell me, man, Jeff, I really love to have something I can send to them. This will be perfect, okay? For those of y'all that are on the line that are realtors, okay, that are located in Florida, okay, I also have a 2-hour continuing ed class. I do a lot of in-house classes for boards of realtors, title companies, real estate offices, lenders, attorneys' offices. That 2-hour continuing ed class, it's approved for Florida continuing education. If you'd like to bring me in to your office, let me know. I'd be glad to teach that class for you guys. I officially cover the entire state of Florida. So I'm able to go wherever y'all need me to go in the state of Florida. Now this class, this advanced workshop, it's only about an hour long. It's not CE. I also have a basics workshop that I teach as well. I do those in-house as well. If you'd like to bring me in just to do a little 1 hour, let me know that as well. All right. And then if you have any clients that have 1031 exchange needs, please send them my way. I talk to people all day long about 1031, and it could be something as simple as, hey, I don't even have my property listed yet. I just have questions. I want to know what some of my options are. Okay, it can be that. It can be that basic, or it can be, hey, I'm closing tomorrow, and I want to do a 1031 exchange, and what do I need to do to get everything lined up? Okay, it can be something like that as well. All right. So let's see. Questions. It doesn't look like we have any. I guess Stephen had a question about the volume, couldn't hear anything, but then I guess he figured it out in a minute. So thanks for attending, Stephen. All right, doesn't look like any questions coming through. But hey, if y'all do think of anything, just shoot me an email, give me a call after we hang up, and I guess we'll just go ahead and wrap it up then. Well, hey, again, thank you for attending today. If today's presentation was a little bit over your head, I do have my basics class coming up next month. I typically do this basics class and I do the advanced class as well, both of these. I'm not sure at the top of my head. I know it's going to be in March. I want to say I'm going to be doing it on the 19th or 20th of March. No, I think it's the 13th, actually, the basics. But if you receive the emails on today's registration, you should receive it for next month as well. If for some reason you don't, let me know. I can send out the registration information, because the basics, we cover more, again, of the basics of 1031 exchange, where today I didn't cover a lot of that because it is an advanced class. All right, well, anyway, y'all have a great weekend. Everybody be safe. Here in Florida, we got some cool weather, so we love that. And again, let me know if I can do anything for you in the future. Thanks for attending today. Bye-bye.